Hey guys, it's Ken. So if you guys are in debt or not in debt, this video is going to be a great one for you to watch. Because as a lot of you guys know, one of the people that I like to study is Buckminster Fuller. And what Buckminster Fuller says is, if you can work with the forces that are happening already, you're going to be way better than trying to work against them. So hopefully you guys know that people are getting into massive debt. They're getting into student debt, credit card debt, homeowner debt, and the government, of course, is getting into more and more debt. Especially now, it's even more transparent with the CARES Act and all the things that they've been doing to try to keep the economy going. But the point is that everyone's got growing debt. The second thing that's really important is that we are heading into a time of inflation. Now, a lot of you have probably never experienced big inflation like a lot of people have in the 70s and the 80s, but all you have to do is go back and see that we've been in a very low inflationary period of time, and now I believe we're heading into a high inflationary time, and I'm going to talk a little bit about that. But since we do know that we're getting into massive debt, and there is a question on whether we're going to be in an inflationary period or a deflationary period, you need to be prepared for whatever it is next for you. And there's lots of things that you can do right now to be on the right side of this. So as all this stuff happens, which you do not have any control over, then you're making money during the next 10 years as opposed to eroding whatever money you might have. So let's start with the first thing. So let's talk a little bit about debt. So as you can see here, the government is putting out lots of money into the economy right now in the form of debt. We're going to get back to that in a little while. In addition to that, there's a lot of people racking up lots and lots and lots of debt, and they're concerned about their incomes right now as a result of this pandemic and COVID and all the things that are happening right now. There's a lot of uncertainty in the market. One thing is for sure, but this debt is slow-moving lava, just like this picture says here. It's definitely coming. It's going to get worse. We're in the middle of the pandemic. There's going to be more money thrown at the economy in the form of unemployment, in the form of PPP or another CARES Act or whatever it might be to get us out of where we are right now. So let's talk about the different kinds of debt. So I talked a little bit about the family debt and the Federal Reserve debt, the government debt, and then our own personal consumption type of debt. So here's a great example of the average U.S. household by debt type. And you can see that most average households are in about $16,000 to $17,000 of credit card debt, about $176,000 in mortgage debt, and $28,000 in auto debt. Student loan debt's right around 50. You get the point. So everybody's racking up this kind of debt. This is really important for you to understand that it's not necessarily good debt, but we're going to show you in a minute how inflation is going to help erode this debt for you with you doing nothing. The second piece is going to be the Federal Reserve or the governments. And if you guys don't already know, what we are sitting in right now is in the fiscal year of 2020, the federal budget deficit was $3.1 trillion. So what that means is that this is more than triple the shortfall recorded in fiscal year 2019. What this means is, if you focus here, the outlays are $6.6 trillion and the revenues are $3.3 trillion. So imagine if that was your own personal home. So you're spending almost 100% more than you're actually collecting. And by the way, this is all public information. You guys should be able to see this. This is at cbo.gov on the topics around the federal budget. It's all here. Go check it out. But the bottom line is that we are hemorrhaging cash at the federal level, and that's creating more and more and more debt, as we talked about earlier. So there's two things happening at the same time. One, the government's creating a bunch of debt, and two, families are also creating lots of debt. So now let's turn to the debt to GDP. And if you guys don't know what GDP is, It's gross domestic product. So you can kind of see what's happening here. This line here is the GDP, okay? So this is the production of the US economy as a whole. This is the debt. And what's happening right now is the US debt is surged by millions of dollars as consumption has declined and businesses have failed. So this right here is the coronavirus. This right here is the pandemic we're going through. So what we have is we have a consumption issue and a rising debt issue. So typically the gross domestic product, or the GDP to debt, like right here, this we had the ability to pay off the debt. At some point in here, we passed, the debt was higher than the GDP. And that's when it starts to become worrisome. And so you need to understand that the government now is in a position where it's going to have to spend a lot more money on the economy to try to keep businesses afloat, to try to pay people's rent, to try to give them income so that they can live and work and eat, and all that stuff's coming. And we're still in the middle of this pandemic. So expect to see more and more CARES Act type programs into 2021. As this starts to continue to rise, you're going to see more and more debt. So the point here is that the government is going to stack more and more debt up, and it's also going to happen at a personal consumption level. So everyone's going to get into a lot more debt in 2021 and 2022 for sure. So now let's look at the next slide, and that's the Fed inflation target, or the Federal Reserve or the central bank's inflation target. And each country that has a central bank has an inflation target. So this is just basic monetary policy, and what they're trying to do is use the interest rates and the inflation rates to keep the economy stabilized. That's what they do, among other things. So what does all this mean? What it means is, in August of 2020, the chairman of the Federal Reserve, Jerome Powell, said this: "It will likely aim to achieve inflation moderately above 2% for some time after periods of persistently low inflation." So the Federal Reserve, in its own admission, is basically saying that now they're going to kind of raise that target, where previously their target was around 2. This is a very important piece for you to understand, because now the Federal Reserve has basically said we are going into periods of higher inflation. Now, nobody knows if that's going to be just above 2, could be 3, could be 4, could be 5, could be 6. We just don't know. And for those of you who might think that 5 or 6 or 7 or 8 or 9% inflation is crazy, just go back and look at history and you'll see the United States has had many years with those figures. So now let's talk about what all this means and what I think it means. In the 1980s, we had a president by the name of Ronald Reagan, and he had a really cool quote. He said, "Inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman." This is the President of the United States saying this to the people. What inflation does is it steals away your savings and erodes debt, which is the whole point of this video. And that's what he's saying here. But again, it's okay as long as you see the signs. You just saw that the Federal Reserve is going to now have just above 2%. What that could mean is that these inflation numbers are going to rise over time and erode not only your debt, but the public debt as well. So the question is, what is 2021 going to be and beyond? One of the things that you guys might be noticing already is that we're already seeing things are more expensive. Things like food, as an example, in this particular cartoon, where we're starting to see food go up, local, national, global. We're starting to see things like components, electronics, things that go into housing like lumber and plumbing and drywall and roofing supplies. Those are all starting to creep up over time. And that's what we're talking about, inflation. The one thing that's not going to rise with inflation are wages. And see this guy here in this water with the shark coming? This is inflation coming after wages, because generally wages are pretty fixed and inflation is going to be higher. So if you're getting a 1% or a 2% raise, as an example, in your annual salary, and inflation we already know was at 2%, you're basically not making any more money the following year. Your paycheck might be more, it might be 2% higher, but you're also losing it at 2% annually, as an example. So these are things that you're going to need to take notice of when you're negotiating your salary. If your wages are trending less than inflation, as an example, you're losing ground. If your loan has a fixed interest, you're probably gaining ground, and we'll get to that in a minute. If your loan has a variable interest, then it's also rising with inflation and you're losing ground. So there are some things that you can do personally right now to make sure that you're beating inflation as we move forward into 2021 and beyond. Let's talk about who the winners and the losers are going to be as inflation comes. So there's lots of people that made lots of money in the 70s, 80s, 90s, and 2000s. And so the question is, what moves did they make as we had high inflationary times and low inflationary times? That's it. They just understood where are things heading, and they put themselves in a position to where they were moving with the forces and not against the forces. And that's what we're trying to do for you right now. One thing is for sure, savers will lose. So here's how it works. Let's say you have $10,000 in the bank and inflation is now 2%. We've seen that. If you look, some years it's been a lot more, but let's say we go into 3 and 4% inflation. Basically that means if the bank's paying you 1, and hopefully you're getting 1 because I doubt you are, and inflation's at 3, you're losing 2% a year on the purchasing power of that money. You still have that $10,000 in the bank. Inflation is eroding it. Remember, it's the shark below the water that you need to be careful of, not what you're making on your savings account. So your savings account's going to show $10,000 a year plus 1%, as an example. You'll actually have the same amount of money, but it will be buying you less. So now let's talk about the next thing, and that is, how do we use inflation to grow our money? Because that's what we all want to know. I can tell you that one, we just talked about savings, not a good thing because inflation's going to be higher than the interest you make on your money. 2, retirees living on a fixed income. Again, let's say somebody gets $1,000 a month. They're going to get $1,000 a month in 20 years. It's going to buy them less. That's what that means. Workers on fixed incomes, same concept. Borrowers on variable rates. Those rates are going to go up with inflation. The whole economy from general economic uncertainty. Exporters will be less competitive. These are things that will lose during inflation right here, guys. I'm telling you, you need to keep your eye on this stuff. If you're in this category, you can easily shift to this side of the category. Debtors on fixed repayment plans. What that means is that if I get a loan, let's say 10 years ago at 3% and inflation's at 3%, I'm basically borrowing for free. That's what that means, because that 3% is fixed. So is the principal amount. If I have $1 million loan from 10 years ago, it's still $1 million today, so I pay it off today in cheaper dollars. That's what it means. The second thing, governments with high public sector debt, owners of land and physical assets. That's what we talk about. Real estate will be one of the hedges that you can invest in along with debt. Real estate itself, the components, the roofs, the paint, the stucco, the drywall, the lumber, the concrete, all that stuff's going to be more expensive to build something later, just like it was 10 years ago. And firms who can cut real wages. These are all the winners we're going to have as we start to see some of this higher inflation. So now let's talk about how the government is going to erode their own public debt, and you, alongside of them, are also going to erode your debt using inflation. So first, let's start to look at the government. So first, I want you to look at this chart over here, which is the annual inflation by the decade. So this is a great chart. You can find this on the internet. I went on and found this in less than 5 minutes. So in the early 90s, which none of you are around, it was almost 10%. Then it was hardly anything. Then it was negative. Then it was almost 5, 2, 3, 8, almost 6, 3. And then, of course, this is the period that we're in right now. And this is where we're projected. Right now, they're projecting it, let's say, at around 3.1%, which I think is probably going to be fairly accurate based on everything that's going on. But the point is, if you don't understand this, guys, and you're trying to invest and you're not considering this, it's a real mistake. These are real tools that you can use to make a lot of money by just understanding this. So now we're going to talk about something that we're going to include for you in the show notes and a link for these people here. These were professors. Joshua Eisenman and Nancy Marion wrote a paper. I love this paper. It basically says, as the U.S. debt to GDP ratio rises toward 100%, which we already showed you is already happening, policymakers will be tempted to inflate away the debt. This column examines the option and suggests that it is not far-fetched. The U.S. inflation of 6% for 4 years would reduce the debt to GDP by 20% in just 4 years. So what did these two mean by that? So what I did is I started to do a little more research. I read their paper, which we'll include for you. You can take a look for yourself. But second, I went back and started to take a look at what did we really do back when we financed the war? Because obviously we're using government money and we're in the form of debt. And what they did here was, as you can see, both the federal debt and the debt held by the public went up significantly during wartime, okay? Not a big deal, but really we're not in a war right now. We are seeing this big increase in our debt right now for something else, obviously COVID-19 and this pandemic. So how did they get it back down here? And what they did was they drove inflation up during those periods of time. And that's what I wanted to show you here, was that the debt went up here, and so did inflation during this period of time. So inflation went up for that 10-year period. And what it did, per this paper, was it lowered the government debt by almost 40%. So right now, as we know, the government's spending trillions and trillions and trillions of dollars on the economy. But one way that they can erode that debt is by letting inflation rise. And that's why I brought up to you earlier in this video, the chairman of the Federal Reserve is going to allow inflation to be a little bit higher than 2%. And obviously in this chart, even they think that it's going to be closer to 3. I don't know where inflation is going to be. Maybe it stays at 2, maybe it's at 3, maybe it's at 4. But either way, it's going to erode that debt just like they did during this period of time, when it went all the way up to almost 5% over that 10-year decade. Now, remember, these are decades, guys. These are 10-year periods. So maybe it's 6 one year, maybe it's 4 one year, maybe it's 3 next year, and then maybe it's 5 next year, maybe it's 3, 4, 5, 6, whatever it is. The point is, we all think that inflation is coming because the government can erode their own debt, as per this article here that we're going to include for you. What it also means for you personally, that you should be in debt too, because this is not just going to happen to government debt. Inflation doesn't care if you have it or the government has it. It just does what it does. And so if you buy $1 million or $10 million of real estate and you have $7 million in loans on it, then your debt is also going to be paid off with cheaper dollars too. So you're going to not only get the cash flow and all the benefits from borrowing fixed rate real estate. So the point is not that the government's going into debt and not that the government's going to inflate the economy with all this new debt to save it. That's not the point. The point is, if you think it's true, then why don't you be on the right side of it? Why don't you also go get into debt? Why don't you buy real estate that cash flows, where you get all the tax advantages, borrow a fixed rate loan at 3%. And then if inflation is at 4, you're actually beating inflation. So you're using other people's money to borrow, plus you're getting inflation on the real estate as a whole, plus you're more likely to get inflation on the rents themselves as things become more and more expensive over time. So do what the government's going to do and let them erode your debt just like they're going to erode their own public debt. So there's two more things that I want to talk about before we wrap up. Obviously, how can we profit from inflation? That's where your head needs to be for 2021. Whether it's your wealth advisor, your financial planner, your banker, somebody that you're giving money with, maybe your own business, even your employer as you're sitting there looking at your own wages. Because if inflation goes to 5% and you're getting a 2 or 3%, you're actually also falling behind from a wage standpoint. So all of those things are going to be helpful for you. So just watch this inflation rate. And in the old way of thinking, in my opinion, debt will now be an asset. Cash will now be a liability. Now, my parents would freak out if I told them this, because in their day, this was the exact opposite. But things are different now. This isn't the 70s and the 80s. This is now. The government is in serious debt, and we are going to see inflation. And real estate will be a hedge moving forward. Now, one last thing that I think you guys are going to find really, really interesting, and that is this debt clock. And so for those of you who haven't seen this debt clock, I would really recommend that you take a look at this. So let me show you something that maybe will blow your mind. As we go onto the internet here, and I type in the US debt clock, hopefully you guys can see that it is moving. This is the national debt. This is the tax revenue. As you can see down here, these are the unfunded liabilities per person at $479,000. You can go to usdebtclock.org. One of the really cool things about this is they have what's called a debt clock time machine. And you can go on this time machine and you can actually type in the year based on the current projections. Of course, this probably does not have the new CARES Act that's going to be coming out, which will actually make it even worse. But let's just go to 2025. As you can see, you know, we're somewhere at around 50. So I would encourage you guys to take a look at this. It's actually very interesting. It's fun to look at. It's crazy to see how fast it's moving. But this alone should tell you that the government's going to be super motivated to have higher inflation, because this is a national debt. These are debts that the U.S. owes. So anyway, have fun with this U.S. debt clock. You can scroll back to current year, prior years, new years, 2, 3, 4, 5 years out, and kind of see where things are trending. Keep your eye on this, because I think that it's really eye-opening as you start to look at the government really has massive unfunded liabilities that they owe to you in the form of Social Security as an example, in the form of Medicare as an example. And there's a number of other unfunded liabilities in addition to the other things that they owe. And all of this, to me, means that they're going to want higher inflation, because as they inflate, then this debt that they owe is going to be paid off, of course, in cheaper dollars in the future. So guys, thanks for listening. Please like and subscribe, share if you guys like this. These videos take time to put together. I enjoy doing them. Hopefully you'll send these on to someone else. And also, I love your comments. Keep those coming in as we try to do more and more videos for you guys based on the stuff that you want. So again, thanks for watching.